Thank you. Welcome to the class. Today we'll be going over common size analysis, trend analysis, and then predicting corporate failure. So we are continuing from the ratios that you have learned and then building up on its usage in your analytics. So we'll start with the common size. I'll just share the screen shortly, then restart. Please, I hope you can hear me.
Yes, please, we can hear you.
Okay, that's fine. Please, can you see the screen I'm sharing?
Yes.
Okay. So you've discussed ratios, and then as a way of interpreting financial statements. Another way you can also interpret financial statement is by doing common size analysis and then index analysis. Then after going through this, we would see how, based on the ratios that we compute for organizations, we can use those ratios to predict if that organization will fail in the near future or not. So when we basically do financial statement analysis, we just want to be able to give stakeholders information on which they would use to make economic decisions. And as business analysts, one thing you should be able to contribute to would be the financial importance of a business to its stakeholders, particularly the shareholders or the owners of the business. So one way we can do this is through ratios, which you have learned, trend analysis, and then common size analysis. So when we say common size analysis, all that we want to do is that when we pick a set of financial statements, when I say a set of financial statements, I mean income statement alone or the balance sheet or statement of financial position alone, we analyze it. So in the common size, or which is also known as vertical analysis, we analyze from the top downwards. Please, you all have seen a sample of a financial statement before, right? During the course of, yes. So with statement of financial position, the common items you usually see is non-current assets, total assets, current assets, and then equity and liabilities. So if you are doing a common size analysis on a statement of financial position, you would pick the total assets, and then each item on the balance sheet would be divided by the total assets. So if you pick an item like property, plant, and equipment, you would pick the value, divide it by the total assets, and then we will see how much of that item we have picked where it's represented in the total assets. That is basically what you do. When you go to the income statement, the base will become your net sales or revenue figure. We would use a financial statement of Farmel Ghana to illustrate when I finish going through the slides. So if you do that, we will say we are doing vertical analysis. You analyze downwards from top down. If it is the income statement, you use revenue as your base. If it's a statement of financial position or balance sheet, you use the total assets as base. Another analysis you could also do is the index analysis, which is also called horizontal analysis. So with that one, you go by line, focusing on each item on the statement of financial position or the income statement. And then you compare it to the previous year's figure or a base year figure that has been given. So if we go to the statement of financial position, we can pick, if it is the statement is for 2023, we can pick the property, plant and equipment value for 2023 and compare it to the plant, property and equipment value for 2022. When you do that, we will say we are doing index analysis or horizontal analysis. Then we can, in the income statement, we can pick sales for 2023 compared to sales for 2022. We pick cost of sales for 2023 compared to the cost of sales for 2022. Because we are doing line by line items, that is called index analysis or horizontal analysis. So you express the current year to the previous year or a base year given, express it as a percentage. Then based on that, you'd interpret it to see if we are doing well or not. So mostly with the index analysis, for some items, you would prefer that it goes up. For some, you would prefer that it goes down. For instance, your sales revenue, it is always ideal that a business, you keep on making more sales. So it would be expected that if we are doing that comparison, then the sales for 2023 would be more or higher than the sales in 2022. But for the cost of sales, it is ideal for a business you incur as minimum cost as possible to be able to make your sales. So with the cost of sales, then we would expect that as the year goes on, it will be better for the business that the cost of sales comes down whilst you have sales increasing. So this is how when you compute the percentages, you would want to interpret it. You would see if it is going up or it's coming down, and then you interpret it as good or bad depending on the item or the nature of the item. Please, do you have any question or I can go on? Okay. So when we want to do index analysis or horizontal analysis or trend analysis, we can do what we call a single base year or fixed trend analysis, or we can do a moving trend analysis. With a single base year, we would have a number of years. We could have four years. So from 2023, 2022, 2021, 2020. Then we would select the oldest year, which in this case will be 2020, as the base year, which we would compare all the other years to. So if we are doing a fixed trend analysis or a single base year trend analysis, then in the case where we have 4 years, 2020 to 2023, when we pick 2023 figures, we'll compare it to the 2020 figures. When we pick 2021 and 22 figures, we'll compare it to the 2020. And then when we pick 2021, we'll compare it to the 2020 figures. Because we are using 1 year, particular year, to compare the subsequent years, we'll say we have a fixed trend analysis or a single base year analysis that we are doing. Then the opposite is having going through what we call a moving trend analysis. With a moving trend analysis, you compare the current year to just the previous year. So with the example where I had said we may have 2023 to 2020 financial statement. When you pick 2023, you compare it to 2022 figures. When you pick 2022 figures, you compare it to the 2021 figures. And then when you pick 2021, you compare it to the 2020. In that case, because the year, that is the base, keeps changing, then we will say we are doing a moving trend analysis. So I want to go on to the practical section before we come to the importance of these, so that we see how the common size analysis is done and also how the index analysis is done.
Yeah.
So I'm going to share a new screen and then we continue from there. Okay, so please, can you see the screen I've shared clearly?
Yes, it's clear.
Okay, so I want to delete these figures. We want to use the financial statement. This file, if it hasn't been shared with you, Dr. Meku was shared after the class. And I'm sure you probably have it already. We want to use a financial statement of Farmer Ghana. And then here we have information on the statement of profit and loss for 4 years. So from 2017 up to 2020. We want to perform first a common size analysis, then we would also perform an index analysis. So with the common, please this side part, I would need you to help me as we go through it so that I won't be the only one talking. Okay. Okay, so we want to start with the common size analysis. With that one, we said when you pick the item, we will focus on one particular year. So with common size, 2020, we'll focus on just 2020. Because this is a statement of income statements, profit and loss statements, the base would be the revenue. So in 2020, all the items that we have here we have revenue, we have cost of sales, we have gross profit, impairment, distribution cost, administrative expenses, other income, operating profit, finance costs, finance income, profits before income tax expense, profits for the year, then we have the total comprehensive income. So these items, we are going to compare it to the revenue figure because we are doing a common size or vertical analysis. So when we pick the revenue, it will be the revenue for 2020 divided by that same revenue, then we multiply it by 100%. So you see that it is 10 to 100. When we go to 2019, it would be revenue for 2019 expressed as a percentage of revenue for 2019. Then we multiply it by 100%. The same thing would be done for 2018 and 2017. Because revenue is the base, since it is a profit and loss statement or an income statement we are working with. If we go on to the balance sheet, then here, if we go on to the balance sheet for the common size analysis, for the PPE, the total assets, which is on row 14, if you can see, would be the base for each of the years. So the total assets of 436,252 for 2020 will be the base which we would use to compare the property, plant, and equipment value to. We would use that same as a base for right of use, intangible assets, inventory, stated capital, retained earnings, all the line items. For a statement of financial position, we will use the total assets. So let's go back to the income statement, and then you are going to help me with the figures to be using for the other years as we go on. So let's start with the 2020. We want to do vertical analysis from cost of sales. So please, which figures am I using for 2020? If you can see.
Well, I don't think that Britain's position will change, but on very much more.
You're using for 2020, you're using 253,604.
Okay, as the numerator, and then what would be the denominator?
373578.
All right, thank you very much. Then you multiply it by 100.
Okay.
Okay. For the gross profit, what figure would we pick?
That would be 119974.
Yes, divided by
The annual
the revenue, then we
sorry,
multiply it by 100.
100.
Okay. For the impairment of financial assets too, we will pick the value for 2020, divide it by the revenue for 2020, multiply it by
100.
then we multiply it by 100. So please, what we are doing, what type of analysis are we doing?
Vertical.
Yes, or common size analysis. So we can do that for all the years. Then we compare, make a comment. The comment we need to make is it a good situation or is it a bad indication when we have such figures? And then what we have done, if we are doing it, we have to go down till the end where we have the total comprehensive income. Since it's the same as a profit for the year, we can end it at a profit for the year. But if we want to make a comment, we would need to look at what the item is. Now the statement of profit and loss just tells us our profit. So looking at the money we have made and then how much we have spent. We should be looking at spending less and then making more. All the items here, most of them are usually a representation of expenses than income, with the exception of the finance income, which is additional income. Items like impairment, distribution costs, administrative expenses, cost of sales are all taken out of the business. Finance costs, expenses that takes money out of the business. So we would expect that we would have that as minimum as what possible. So if we want to interpret the cost of sales figure we have computed, in 2020, we are saying that our cost of sales took 68% of our revenue value. And then if we are having that, do you think it is good or bad? As a business, that you'd have
Bad.
your revenue, it's bad, yes. So with the cost of sales, when you're expressing it as a percentage of the revenue, the minimum, the better. And then we can see that in 2017, it was 53, which is, based on the 4 years, it is the best amongst the 4. Then it increased to a bad situation, came down slightly, and then it has gone up. But the percentages taking more than 50% of your revenue, your cost of sales taking more, we will see it to be what? Bad. And then because it is bad, that is what is accounting for our low gross profit. Because when you take the 68%, it is 32% that will be left for you as your gross profit. That would also imply that if we want to check the percentage of expenses like distribution cost, let me just do that for the distribution cost, for instance, is taking 23% of your revenue. So now it means that you would be left with very minimal amount. How would we know that? Let's check the net profit when you express it in terms of the revenue. Oh.
Open another cup.
So if we look here, we are reporting profit of 514, right? But in effect, it's 0% of our revenue. So basically, we have spent almost
Loss.
everything. We made
From
losses.
break-even.
Yes. We just broke even, like you said. Which, if a business is existing just to break even, then what is the point of your existing? Unless you are an NGO, then you don't exist to make profit. But if you exist to make profit, then you don't want this situation. So that is when we check, you see in 2017, they made at least 11% was left. Then 3% in 2018, 6%, and then in 2020, it's basically 0. So you would see that you would conclude based on this that the business is just doing what? Bad. If you look at the expenditure items too, you would see if we were to go on, you will see that most of the expenses will take a bigger part of the revenue, and that is why we are coming down to 0. So that is how you do vertical analysis and then how you interpret it. So here we would say that it is bad. Here, would you say it is okay or bad with your gross profit?
As in 2020 and 2017. Are we looking at 2017?
You across board, you go across board.
2017 will be better than the rest of the years.
Okay, so 2017 is better, but then so generally currently would you say the business is doing well or is doing bad?
It's doing bad.
Okay, so because it keeps going down, it will be bad. So that is how we would discuss it. But when we come to the administrative expenses, you will see that it was 9. Administrative expenses currently takes only 9% of our revenue. With that one, we will say it is somehow good, right? So that is how you'd interpret the items line by line when you do a common size analysis. When you compute for each year, you can, depending on the situation, look at the values over the years and make your judgment. Or depending on the nature of the item, you conclude that is bad or good. Basically, this is common size analysis. Please, do you have any questions related to common size analysis?
Please, I have a question.
Yes, please go
on. I guess this is not the only interpretation we can give to this analysis, right?
With a common size, this is just what you do, and then that is the comments that you would make. So usually it is not the ideal tool to use when you want to analyze the performance of a business.
Okay. I was thinking, for instance, looking at what you did, I would say maybe our question, what factors contributed to the cost of sales to get this kind of figure out of the total revenue?
Yeah,
thinking,
so because that is bad, you need to do extra investigations.
Oh, okay.
So how we would know if the nature, for instance, what goes into cost of sales that is making it account for 68% of this year's value. To be able to understand it better, we will need to do an index analysis, where the index analysis, we are looking at the cost of sales over the years. And that will tell us whether the cost of sales has been increasing or not. So let's go on, then we could come back to your comment and then probably understand it better.
All right, thank you.
You're welcome. Please, any other question? Sales ahead. Okay, so we want to do index or horizontal analysis. Here, we would look at the two types that we discussed. We said there is a moving trend and then a single or fixed year analysis. If we are doing a single base year analysis, in this case, then 2017 will be the base. So when we pick revenue, we'll compare the revenue of 2020 to revenue of 2017, revenue of 2019 to revenue of 2017, revenue of 2018 to revenue of 2017. When we do that, we are doing a single or fixed year trend analysis. We have picked one particular year to be our base. The common one that is done is a moving trend analysis, where the previous year, the immediate previous year becomes the base for the current year. So we will do a moving trend analysis with this question. So we will pick sales of 2020, then the base year will be the sales, the same thing, or revenue for 2019. Then we multiply it by 100. Then we would also pick 2019 figure. Then the base would be 2018. Then we multiply it by 100. Then we will pick 2018. The base would be what? 2017 revenue. We multiply it by 100. Then the base year for 2017 would be 2017, since we don't have any other previous year. So 2017 will be the fixed year. So please, what do you observe over the years with regards to the sales figure, or the revenue figure? Between 2020 and 2029, is there an increment or a decrease?
The sales will remain in independent way. But
Please, what are you saying?
and so
There is a decrease in revenue.
There's a decrease in revenue. Okay. So let's do the same computation for the cost of sales, and then let's see. So the cost of sales for 2020 divided by the cost of sales of 2019 multiplied by 100.
100%.
Okay, I want to have it reflect. Okay. So if we look at it percentage-wise, the cost of sales in 2020, did it decrease or increase?
Decrease.
Okay, so let's go back to how we interpreted the common size analysis. In the common size, we said the cost of sales for 2020 was taking a bigger chunk of it. And then one of you was asking that, then we need to look into why that is happening, right? When you do the index analysis, you would see that in our scenario, the cost of sales is decreasing. So then it shouldn't, this percentage shouldn't be so. The problem here is with what? The revenue. Do you see that?
Yeah.
So if we do common size analysis on its own, it is very scanty. We need to support it with index analysis to be able to make a more meaning out of it. See which of the items is causing the problems within the entity. So in this question for Fanmo Ghana, then the issue is revenue and not cost of sales or any other thing. So then we can now go and find the reasons why in 2020 they recorded this minimal.
A research gam come.
So if we all remember what happened in 2020.
Please, I can't hear you.
I said one of you was asking, we look into why the cost of sales is accounting for a big part of the revenue when we did a common size. And I said, when we do the horizontal or index analysis, it will bring out the issue. And then with what we have done, we have seen that the cost of sales is not the issue, but the revenue. So I'm asking, what happened in 2020? This is Fanmo Ghana's financial statement we are using. So what happened in 2020 that would have accounted for that decrease in their sales?
There was low patronage.
Okay, so if we all remember, 2020 was when COVID hit Ghana. And then from a big part of the year, people were working from the house, people were on lockdown. And then if you don't go out, you don't buy Fanmo products, unless you have
it's true.
like some of us who would intentionally go and buy. The kids stay home for a year before they went back to school. And they patronize those things a lot than the adults. So that could account for it. So what I'm saying is that when we make this type of analysis, it doesn't just end there. These are the accounting, the figures. You need to think about what is happening within the business, what is happening outside the business that could impact these items. And then that would help you make more meaning out of this type of analysis, that is when you do that. Is there any question or contribution?
So, Madam,
Yes.
why don't we, if it is so, why don't we focus on the horizontal analysis, leaving out the vertical one? Because if this and the vertical alone can give more meaningful insight, unless it depends on this, why do we have to worry ourselves with that? Not necessarily going straight to the index one.
Okay, so for a business or an analyst, you will decide which one to use in each scenario.
Oh, okay.
But sometimes when you use the common size alone, it doesn't give you a clear picture. You need to use the index or horizontal analysis.
No, my
Most-
question is, I'm asking.
Yes, I'm coming to answering it. Even with just the index analysis, most people prefer not to do it, because if you see that revenue is decreasing over the years, someone will ask you, so what? And most people would prefer to use the ratios which you have learned to do the analysis than these two. So mainly horizontal analysis and then common size or vertical analysis are not really used that often when they want to make an analysis. But
Madam,
the choice depends on the entity and then the one doing the analysis.
okay, so if I understand you, that means when you are given a financial statement to analyze, and you are not specified to use particular, well, you can either use the ratio aspect of it, or you can use this index, the vertical and the horizontal aspect, right?
Okay, so if a question is very vague, okay, then I would say the ideal thing to do would be to do all of it. That is in an exam-based situation.
Okay.
But so you do the vertical, you do the horizontal, and then you compute some ratios. And then the ratios, you need to compute it along those broad categories are profitability, liquidity, efficiency, gearing, and investment ratios. So, and then did you say A?
I see.
So generally, if a question is very silent on that, it would imply that for at least each of the main broad categories of ratios, you compute minimum two.
Okay. All right.
For some, they only have 2 ratios under them. So you compute 2 profitability ratios, 2 liquidity ratios, 2 gearing ratios, 2 efficiency ratios, and then 2 investment ratios. If you have that information, then you can do index analysis and vertical analysis to support your answer. So the main thing you'd focus on would be the ratios, okay? Then when you compute the ratios, in making sense of the ratios, you need to come back to the items of the ratio. For instance, profitability ratio, okay? Net profit divided by sales. That is just like vertical analysis that we have done.
Oh, yeah.
Because you pick the net profit for 1 year, and then you express it as a percentage of the sales for that same year. That is the vertical we have done.
Yeah.
Then to make meaning of it, if we are not being profitable, you need to look at what goes into the business not being profitable. It could be their expenses going up. It could be their revenue coming down. And then the index or horizontal analysis would be what would support you to make a case. So I don't expect that you'd be given a question where it doesn't tell you which type of tool to use, because that would be a big punishment. But practically, if you are using it in your businesses, then as a business person, as a business analyst, you would use which of these, any of these, based on the information you have and then your ability. So you need to know and understand these, so that maybe you are 3 analysts in a business. One does this, tries to prove a point with theirs, and then would be making a wrong point. Because you know it, you can counter it and then give a correct way to do it.
Thank you very much.
You're welcome. So,
Madam, can I also
yes,
come
please
in?
come
I
in.
just want to say, can we say that the common size is giving you analysis of your performance for each of the years, and then the horizontal or index is giving you your growth in terms of comparing to the previous years?
Yes, you can say that. You can say that. But in terms of the line items, so basically, you can't use one without the other. If you want to do a very good type of analysis, you can't use one without the other. Because if you use a common size and then it's giving you what is happening within the years, you need to understand why it is so. And then the horizontal would tell you why it is so. So you need to use both together. And then, although it will give you that picture, you need to put the two together to make very good sense of the business information that you would have.
Okay.
And mostly this we are in 2024. We are using 2020 statement. For most entities by now, since we are in July, most entities should have their 2023 financial statement out, which is also based on past information. But with the course you guys are doing, if you are in an entity that places value on big data, that means you should be able to generate even future information relating to the accounting and financial performance of the business. So you should be able to predict their performance and then give them outputs of what revenue figures they should expect based on this type of analysis for future references. But I don't know if a lot of entities in Ghana have subscribed to using or adapting technology to be able to help us apply what we learn in school very well. That is something. Is any other comment? If not, so what do you think would be the importance of doing the index analysis or the common size analysis, this type of analysis? Its importance.
To know the revenue position of the organization.
Okay, what else? Let's go back to the slides.
Oh, madam.
Yes.
I wanted you to shift your sheet a little for me to have a look at something,
Okay,
if you don't mind.
no problem. Let me just share it again. Please, what do you want to look at?
I can't see. Can you move? Yes, thank you. Can you?
But we will share this material with you.
No, I'm having a look at something.
Okay.
I'm very grateful. Please, you
Okay.
can now take it off. Thank you.
Okay. You're welcome. Okay, so please, back to what we're discussing, the importance of doing this type of analysis, whether index or horizontal, index or vertical analysis. Someone said to know the trend in revenue.
Also, to help us identify, set as a stand for us to identify what is happening within organization or outside the organization that is influencing revenue.
Okay, so basically it will just help us to determine the cause of the change. When you see the change, then you need to find ways to explain why the change. And then you can't explain the change without looking at each of the items. And that is why you'd always need to combine these two. So if, for instance, if you check the trend within an item, sales is increasing, then that is good, right? If your sales is increasing, then it's very good. But then if you check and then the cost of sales is also increasing, then we wouldn't have a good picture in the end. So basically, when we do all this, we just want to be sure that whatever is happening within the business would continue or come to an end. So like I said, in the question that we used, we saw that the revenue was going down over the years. It goes down, then it goes up, then it goes down, then it goes up. We can, based on that, say that for 2021, revenue may go up, right? Then in 2022, it will come down. Then in 2023, it will go up, because that was what was happening within the analysis that we made. And then based on that trend, we would be able to project that then in 2024, we should expect that our sales figure will come down. In 2025, it will go up. We are not yet in 2025. So what can we do to make sure that we get the increased sales that the trend shows that every year when we go up one, we come down one? Like that trend, what can we do to change it that we are going up all the way, or if a year we need to go up, we make sure that we go up very high. That would make the business more profitable. And that would be your job as a business analyst, to interpret it that way. Because that's for share the screen. For common size and then trend analysis. The rest of the slides was just showing you samples of the common size analysis and index analysis, and then that is what I showed you using the Excel sheet. Okay, please can we go on?
Yes.
Yep. Down.
Okay. So when we do this type of analysis, be it the ratios, the index analysis, the common site analysis, you should be able to tell or advise stakeholders whether this business is going to fail in the long run or not. Because if you are a customer and then you are attached to that, the product of that company, if they fail, then it means that with time, you wouldn't get that product you so much cherish. So you may need to start looking for alternatives. If you are an employee, if the business is going to fail, that means you are going to lose your job. So you need to start looking out for other employment avenues. If you are the shareholder, you are going to lose your money that you have invested. So you need to start calculating how much you are going to lose. So it's very important that you use weather ratios, index analysis, common size analysis to be able to predict the failure of a company or a business. So that is what we are going to go into the next part, how we use the ratios and then these things we have learned to be able to predict if a business is failing or would fail. So let me just share the screen. Corporate failure. Okay. So we want to go into corporate failure prediction. And then we want to use financial data to predict whether a company will fail. And like I discussed earlier, we need to know this because for various stakeholders, if a business fails, it implies
I want you to answer
something else. So to be able to do this, we can use univariate analysis or multivariate analysis or balance scorecard to be able to predict if a business would fail or not. The next part of the lecture is long, a lot of theory. So please don't doze off and leave me here. Okay. So in trying to predict failure, researchers have proposed that we could use univariate analysis. Univariate analysis means that we are using just one measure, one particular measure, or multivariate analysis, we combine a number of measures together, or we do balance scorecards, which is more of looking at some items and checking the box whether these things are happening within the entity or not. So we want to go on with the univariate analysis. So with that one, you use one single ratio to predict whether the business will fail or not. So you have learned a lot of ratios, right? Current ratio, quick ratio, return on equity, return on capital employed. You can pick any one of them. And then based on that, look at, for instance, if you pick the return on capital employed, you compute the return on capital employed for a number of companies, or if it's one particular company, for a number of years, and then look at the trend. So with your return on capital employed, if the business is profitable, you would want to get higher returns, right? So if the business keeps making a higher return on capital employed, then we can conclude that the business will not fail. But on the other hand, if the return on capital keeps decreasing over the years, then we would conclude that the business is likely to fail. So this is somebody's research work that they did. I'm sure most of you have started writing your thesis already or about to start. So someone sat down and did research. And then their research, they picked one particular ratio and then checked the performance of listed firms on the stock exchange using that ratio as a base, and then decided that if you fell below this threshold, you are going to fail. So firms that they call non-distressed firms means that you are not failing. And their ratios, firms that they said are doing well, they were used as the base to compare with others, those that had failed already. So firms that were no longer listed were compared to firms that were still listed. Those firms still listed were seen as non-distressed. And then they compare their financial ratios to see that, okay, for firms that are still listed, then their financial ratio should be good. Give a very good picture. That is the univariate way. And if you are not doing well, then it is assumed that you are going to fail. So some of the ratios that you could use would be low profitability. So when you come to your profitability ratios, if you pick one of them, if it is low over time, then you would say that the business is likely to what? Fail. Then when you compare your investment ratios, such as the equity returns, if it is low, then you will say that the business is likely to fail. Or you could look at their liquidity, how much they're able to meet their short-term debt, looking at their quick ratio and then their current ratio or the asset test ratio. And then that will tell you if they have enough cash to meet their short-term debt. Please note that with the univariate model, you are not going to use all these three. You would pick only one. So if you pick a profitability ratio, then if it is low, because it is low, you would be able to say that because they keep making low profits, then the business will fail. If the returns on equity is low over time, and it keeps reducing, you look at just the return on equity, just one particular ratio, and say that because of that, the business is likely to fail. You could also look at their percentage of borrowing. If they've borrowed too much, which is high gearing, then you would say that the business is likely to fail. Then you check how their income varies. If it varies too much, it goes up, then it comes down, then it goes up again, comes down. There's no balance in how it changes. Then you can also, based on that, say that the business is likely. So using the research that I did, using interest cover, how much they could pay their interest, that is their finance interest, with the profits they had. If you look at it, they use companies A to J, right? Which had failed, and then those which had not failed. Company I had not failed, and company J had failed. But company I's interest cover is less than Jane's interest cover. So that means that if Jane was still existing, it could pay off its interest on its loans, and then I, which still exists, cannot what pay. So if you were supposed to make a judgment, then you would say that it is I that should even be classified as failed and not Jane that had failed. Please, do you get it?
Please, can you repeat it again for us?
Okay.
Your voice keeps going down. It comes up and it goes down. So
Sorry. Okay. So we are discussing how to predict corporate failure if a business will fail. And then we are saying you can use ratios. And in using ratios, you can use what we call a univariant model or analysis. in that analysis, you pick one particular ratio and then use it as a base to predict the failure of an entity. So you can pick, for instance, profitability ratio, pick just return on capital employed, and then use that.
Yeah, paid that amount of money. We know also that he Manchester United just got a good central defender within a year for 60 million. So yeah.
Okay, so you can use return on capital employed, and then with return on capital employed, use just that return on capital employed for a number of companies or even for one company over a number of years, compute it, and then determine whether the business will fail or not. So we want to see how it was done in research. And in research, someone picked interest cover ratio, which shows how much your profit, net profit, can pay off your interest expense. Usually they use your profit before interest and tax, and then they'll see how many times it can pay off your interest on your loans. For company A, they said based on the ratio, they can pay off their interest on loans 4 times. B can pay 3.6 times, C 3.4. When you come to J, it can pay 1.4 times, I can pay 0.1. If we look at the status of these funds, the non-failed means that the business still exists, and the failed means that the business has gone bankrupt or liquidated already.
Okay.
And then I was saying that when you look at J and I, J is no longer existing, so it has failed. But its interest cover ratio shows that they can pay off its debt more than the one I, which has not what? Failed. If you compute the average of the ratios for the failed and the non-failed, let me use the I want to use the Excel sheet. And please give me a moment. I want to copy something and then continue, then I show you.
Okay, madam.
Okay, so this is the information that we have, right, from the slides. I'll move on to the slide shortly. With the failed businesses, the 10 businesses that's reported here, 3 has been classified as failed, and then 7 as non-failed. What it means is that these 7 firms are still in operation, and then the 3 firms have failed. Their interest cover ratio spans from 4 to 0.1 being the minimum. We want to compute the averages for each category, the failed businesses, and then the average for the non-failed, to be able to make comparison with when I was discussing the G. So with the average, I'll add up the 3 ratios for the failed, then divide it by 3, since it's 3 businesses. So we have 0.566, or 57. Then computing the average for the non-failed, divided by 7, since it's 7 entities. Okay. So if we want to base on this, we would say that for if we want to classify a business as failed, then at least it should have an interest cover of 0.57, right? If your interest cover is 0.57 or below, then we'll say you have failed. If we say you have not failed, then you should be 2.7 or better, right? So if we want to go and look at the information that we have, please, you can see the screen, right? Company F is not failed, but does its ratio fit the ratio you need, which is 2.57 to be classified as non-failed? Please, are you with me? And then can you hear me?
Yes.
So per the averages that we computed, if a business has not failed, then its interest cover ratio on the average should be 2.57 or 67. If we will classify you as failed, then on the average, your interest cover ratio should be 0.57. So now we want to go, if we look at A, its classification is right, it's correct. Because 4 is above the 2.6. B's own is above, C, D, E. They all have interest cover ratio that is above the average of 2.67. But if we look at F, it is existing, but its interest cover ratio is 1.6. Isn't that below the average for a business that has not failed?
It is.
So based on that, we can conclude that F is likely to fail. Because its average is below the, its ratio is below the sector average for those which have not failed. If we look at I, it has not failed. It has a ratio of 0.1, which is even below the average ratio for non-failed businesses, which is 0.57. So as for I there, we should conclude, say, it has already what? Failed. And that is how you use one particular ratio to do the analysis. That is how it was done. They pick businesses that have failed. Then they'll compute, if it's interest cover ratio for those entities, compute the average. Then they'll pick entities that are still existing, compute the interest cover ratios. Then you compute the average. Then you compare the averages and see whether an entity within one of the categories would be classified as failed or non-failed. Because we are using just one ratio. It is called a univariate analysis. We are just using one particular ratio to do that. Please, you get the univariate. So
Okay, so what about the 1.4 field?
Yes. So in a situation, how do we then classify 1.4? We don't know, right? Because it
Yes.
doesn't qualify to be non-failed. And then its ratio also doesn't qualify to be failed. So that is a problem with using one model. The cutoff point would leave you with entities that would be in the middle where you don't know what to do with them. And that's because of that, people have advocated that you use a multivariant model instead of one. Oh,
Oh, okay.
so you need like like I was saying, the main issue would be to identify the appropriate cutoff point so that you don't misclassify failing businesses as non-failed and then non-failed businesses as what? Failed. When you misclassify them, we call it type 1 and type 2 error. So if you say a failed firm is not failed, it is type 1 error. Then if you classify a non-failed firm as failed, it is type 2 error. But usually the cutoff point, you'd need to make judgment. You, the person doing the analysis, will need to make judgment. And nobody would want to say, especially if you are the owner of the business, that you want your business to fail. So if it is me, I am doing this univariate analysis, then if my ratio keeps decreasing, then I also decrease my cutoff point so that it will look as though my business is doing well, so that I don't classify myself as failed, because no one wants to be a failure, or you wouldn't do that. If it's your business and you are doing this analysis, and then you compute the ratios, and then over years, it keeps going down. Now you need to determine the cutoff point that you would base on to decide whether your business has failed or not. Would you set a higher cutoff point such that your business will be seen as failed, or you'd rather reduce the cutoff point to make it look like you have not failed? Please, I'm asking a question.
One will make it as reduced.
One would reduce it.
Yeah.
Okay. All right. So one would reduce it just to suit themselves. So what I can say is that when it comes to making a judgment for the cutoff point, it really depends on the owners of the business, because if nobody would want to say that their firm would fail, so they will do as much as possible to reduce the cutoff point to suit themselves over time. In research, Beaver 1966 used univariate model to predict if businesses have failed. And they used 79 failed firms, and then found each of the 79 failed, they found a firm that had not failed, that worked in the same industry and with the same size. So for instance, if we go to the telecommunications, now it is, you have three. We will say mainly either you are using Airtel to go, they call it AT now, AT, Telecel, or MTN. Everyone knows that MTN has a bigger share, and then I would assume that AT has a minimum share. So if we are, please, this is an assumption. If any of you work with these entities, don't take it too personal and come attack me. If we assume, for instance, that AT has failed, that is, they have gone bankrupt and collapsed, and then MTN has not failed. That is how you compare. You pick AT and then you compare it with their ratios with that of MTN. That is what was done. So they picked 79 firms that had failed, and then they'll compare to another 79 that had not failed. But each match would be with a firm that operates within the same industry and they have the same size. And they computed their ratios 5 years before the failed firms actually failed. So 5 years before, were there any indications within your ratios that you would find you fail? They used 30 ratios, but please note that these 30 ratios were not combined as one. Each of them were used differently. So some of the ratios they used was the cash flow to debt. And then if you look at the non-failed, please, those are the ones with the red lines. You see that they have a higher cash flow to debt ratio than those which had failed.
Madam.
Yes, please.
My screen, I'm only looking at the Excel sheet, so I don't see any other thing. I see the field of 1 point, what we did, and the average we did.
Okay, thank you. Please, can you see?
Thank you.
Oh, okay, sorry. So that means you didn't see the other stuff I was talking about plenty. Okay, sorry. But please, you have the slides already. I'm sure if you don't have
Yes,
it.
we do.
Okay. Okay, so please, most of the aspects I was talking about are in the slides. Even the ratio that the averages I computed is already in the slide. Okay, and then the type 1 and type 2 error I was talking about is also here. Okay, so if we look at each of the items, you will see that, for instance, net income to total assets. The red ones are those that have not failed. The black have failed. The failed entities have a lower net income to total assets ratio than those that had not failed, which is good. If you are failing, you wouldn't have a higher net profit. If you come to their total debt, that is their gearing, you will see that those that were failing have a very high gearing ratio as compared to those that had not failed. Theirs were around 37%. The ones that had failed, there was one that had 79% of its debt, its total assets related to debt as debt. So that is how they did it. Each of the businesses, each ratio was analyzed separately, not together as one. You look at one and then you move on to the other one. And then if you look at it, you see that there's clear difference between the various groups, right? For instance, with the current ratio, your ability to meet your short-term debt liquidity ratio, those that have not failed were more liquid than those that failed. Their working capital to total assets, those that had not failed had a higher working capital to total assets than those that had failed. So based on that, it was clear to see that you see the trend that generally those that failed were not doing well, and then their ratios kept going worse over time. So using the cash flow to debt equity, they said that they were able to predict that 78% of the businesses would fail before 5 years before they actually fail. So 5 years prior to failure, if you had looked at their cash flow to debt ratio, it would have told you that their business would fail. And as such, they concluded that if you want to predict the failure of a business, then it would be best to use this cash flow to debt ratio, that particular one. So we can, as a class, probably look at firms listed on the stock exchange and then look at their total, their cash flow to debt, total debt ratio, and then tell over the years whether it looks like they are going to fail or not. Because we are using one particular ratio, then we will be doing what we call. Do you have any questions? So, for instance, you see.
Hello.
Yes, please.
When you got to some point, we couldn't hear what you were saying. Yeah, we didn't hear anything you said.
Please, to what point?
When you were talking about comparing, when we look at companies on the stock exchange, we can predict if they will fail. From that side, we didn't hear anything again.
Okay. So what I was saying is that if we want to use the univariate model to predict if the firms listed can fail, Beaver 1996 concluded from their study that with the various ratios they used, the cash flow to debt ratio was the best one that was able to predict that companies will fail 5 years before its failure. So what I was saying is that if we want to replicate this study, we can pick firms listed on the Ghana Stock Exchange now, and then look at their cash flow to debt ratio, and then see the trend, and then based on that, see whether they will fail or not. That was what I was saying, in the near future or not. But I wanted us to look at the various ratios because they use different ratio and not one particular ratio. It's possible that when you compute the cash flow to debt ratio for one entity, it will be bad. So you would say then it should have failed, right? But if you come and compute the net income, it is also possible that they would be part of the non-failed group. So if you are using one particular ratio, even if you are computing all the ratios, but you look at them, each one on its own, as a base to determine whether an entity will fail or not, it is likely that you would classify the businesses differently based on each of the ratios. So let's say that we have, if we are using total debt to total assets as a base, and then we are also using net income to total assets. It could be that an entity that has failed has a very low proportion as debt. So its debt to total assets will be very low, okay? So because it is low, we will classify it as not failed based on the total debt to total assets ratio. But for that same company, if we compute its net profit or net income to total assets, because they probably made a loss, it might come to the negatives. And then because it's coming into the negative, for another ratio, we'll classify it as failed. So if you are not careful and then you are using only one ratio to be your base to predict the failure, you may need to classify or classify businesses differently based on each ratio. The classification you give for a business for each ratio would be different. So for one ratio, you may say, maybe if you are using MTN, for one ratio, you say MTN is successful. For another ratio, you go and say, based on this ratio, MTN is not successful, and then it will fail. That is one of the problems. A single ratio, your base. So to be able to—
Hello.
Yes, please.
We didn't hear that part again. I didn't hear that part. You said that was one of the problems. What?
When it comes to using just one particular ratio as a base for predicting corporate failure,
Okay.
it is possible that you would misclassify, or depending on the ratio you use, you classify a business as failed, and then in another ratio, you classify it as not failed. You might not, the classification will not be consistent. If someone uses profitability, based on profitability, the business may be failing. But if another person picks a gearing ratio, based on the gearing ratio, that same entity would be classified as not failed. So there will be some inconsistencies if you are using just one particular ratio to do the prediction. So they have proposed that instead of using one particular ratio, you combine the number of ratios. And that is the multivariate analysis. That is using a number of ratios. So we want to go on to the multivariate analysis. Please, is my line, is it like I'm breaking off or?
Yes, you are.
Sorry, is there a network? Okay, but we would, if I'm breaking off, then please you prompt me earlier so that. So with multivariate analysis, you determine what we call z-scores. And z-scores usually it's someone's research work where they've tested a number of ratios in an econometric model, and then they have come out with weights that they have assigned to those particular ratios. And they claim that when you compute the those particular ratios we will come to look at, and then you attach the weights they have found based on the econometric model to them, you should be able to tell whether the business will fail. So in this case, you are not relying on just one ratio at a time, but a combination of ratios put together as one in the multivariate analysis. Then, so this is the formula for it. Z is the value you get, and then based on that, you say the business has failed or not. We will get to the value that would say it has failed, and then the value will say it has not failed. Then A, B, and then X are the weights the various researchers have attached to the R1, which are the particular ratios. So R1 could be return on capital, R2 could be quick ratio, RN could be net profits margin ratio. So the R's are different ratios. And then A to B are the weights. The weights that shows how important they are in this equation. So and I gave example of some of the ratios that you could use. Please, the weights that you'd see are not something that we would generate. people have done their research within that context, and then they have come up with ways to attach to it. So in one formula, you will see that the weight attached to the same ratio would be different from in another researcher's work. So we want to look at Altman Z-score mainly, and then how they use it. But the other ones you can use will be the Taflet Z-scores, PAS scores, and then A scores. But we would mainly focus on the Altman Z-score. So Altman decided that Beaver's research was not sufficient because of the concern I raised that you may classify a firm inconsistently over time in different ratios. So he said that then the best solution would be to combine a number of ratios. So they picked 63 manufacturing companies, 33 that had failed, and then 33 that had not failed. And please hold on out. Let me take like a minute break, please. Hi, sorry. I'm back. So Altman used 66 companies, 33 failed, and then 33 that had not failed. And then they picked 22 ratios. 22 ratios from liquidity, profitability, leverage, solvency, and activity ratios. And then based on these formulas, generated this weight. So we would, I want to go to the last slide where it has all the full formula. Okay, so the 5 ratios that they used were sales to total assets ratio, market capitalization to book value of debt ratio, earnings before interest and tax, which is the same as profits before interest and tax, divided by the total assets ratio, retained earnings over the total assets ratio, then working capital over the total assets ratio. So X1, X2, X3, X4, and then X5. And then based on their outputs, when they ran the regression model, they got these weights. If you look at the weight, you will see that sales to total assets is giving a very high ratio, which is very important in predicting the failure of what? Businesses. Then it is followed by
I can't hear you.
Please, you can't hear me.
I thought we were not hearing you. Kindly continue.
Okay.
Please repeat what you said, because we didn't hear that part.
Please, you heard X5, sales to total assets being very important.
No, please.
No.
Okay. So what I'm saying is that this formula, okay, according to Altman, if you want to predict if a business would fail, you should look at these 5 ratios. The working capital to total assets ratio 1, retained earnings to total assets ratio, the earnings before interest and tax, or which is the same as profits before interest and tax, to total assets, the market capitalization to the book value of debt. Market capitalization is usually the share price, how much they sell their shares on the market. And then the sales to total assets ratio. So when you compute these ratios and then you put them in this mathematical formula together, it should give you some values. And then based on the values given, you would say a business has failed or not failed. But what I was trying to explain is that when you look at the model, the most important one, or the one that seems to be of greater importance because of the weight attached to it, is the sales to total assets, because it is supposed to account for 99% of a business being predicted as failed or not. The others are even less, 1%. But what I was saying is that the fifth one, sales to total assets, is the most important. Then according to Altman, if you score 3 or higher, you are not likely to fail. But if a business gets 1.8 or below, then the business is likely. So the question is, what happens to businesses between 1.9 to 3? How do we classify them? That we can't tell. It's a gray area. So when a business is between 1.8 and 3, we can't really say whether they are failing or non-failing. And that is one issue with the Altman's Z-score. But the researcher claimed that they only misclassified 5%. That means they were able to classify 95% of businesses that failed as failed 1 year before time based on their model. So if you use their model to predict whether a business will fail, according to them, your chances of making a mistake that the business will fail or not is only 5% if you're using their model, 1 year to the business failing. And then it is 17% as business fail. But in 2000, they found issues with their initial 1977 model and proposed this new model. The main change in this model is the D, the X4. Here they are using the book value of ordinary shares to the total debt. That's the book value of debt. That is the ratio that had changed. The first one, they were using the share price to debt. Now they are using book value of equity to the book value of total liabilities. And with this model, you can see that the Z-scores have also changed, but still greater importance is on the E, sales revenue to total assets accounting for a bigger part of the ratio. So if you look at their weight, it should tell you that generally the sales to total assets ratio, how you're able to convert your assets into sales is the most important thing when it comes to predicting whether an entity will fail or not. So we could use this formula to predict the failure of entities on the Ghana Stock Exchange. And that will likely be your assignment, one of your assignments for this course, where you would use the Altman Z-score 2000 model to predict whether businesses have failed or not. So let's try our hands. Yes, please, Michael.
Yes. When you look at this formula, for C, that's the operational profit. We have the constant is 3.1. I mean, that one is higher than the
Yeah,
the total.
yeah. Thank you.
So
thank you. Thank you for drawing my attention to it. Okay, so as he's saying, the constant is 3.1, which means it is higher. So the profit you are making is of more importance in this model, the 2000 model, than in the 1977 model. So we want to practice what we have learned with our FANMOG financial statement. So we want to compute the Altman Z-score based on this formula with the information we have from FANMOG. But like I was saying, what we are coming to do after that would be your assignment. You would be assigned companies that are listed, not just on the Ghana Stock Exchange, but in Africa, where you would need to download their financial statement for a number of years and then compute their Z-scores and then determine whether they will fail or not based on the Z-score that we would generate. But the key we need to take is that when we compute the Z-score, if a business has a Z-score of 3 and higher, then we will say that it will not fail. And then if it is below 1.8, we will say that it is likely to fail. Please, you don't say that it has failed. You use the term likely to fail. So please, let's go on to the example using FANMOG Ghana financial statement. So I'll just share the screen, then we'll continue from there. Okay. So we want to compute for Altman Z-score for Farmer Ghana. But before we can do that, we need to find a number of ratios. The first one is working capital to total assets ratio. Please, what's the formula for working capital? Please, the formula for working capital. I'm waiting for response from the class, please. Oh, please, you are not, okay. I don't know if. Working capital.
Current assets over current liability.
Okay, so when we come to the
Current
balance
assets
sheet,
minus
we would have our current assets. We want to use 20, okay, we will do for the various years. So current assets minus current liabilities. And the current liability for 2020 is 164.18. Okay, so that is our working capital. The total assets, I want to pick the value so that when from the balance sheet, the total asset is for 2020. 2020 is 436,252. Then we would also operating profit. Operating profit will get us from the statement of profit and loss. Here we will pick this one, operating profit. Please, it's usually the same as profit before interest and tax. So if you don't see operating profit and then in a financial statement, you see profit before interest and tax, it's the same as the operating profit. Then our book value of equity. Is a value of total equity in this situation. So stated capital plus the retained earnings. Then book value of total liability. So total liability. So you would also get it from the statement, statement of financial position. And that is a total liabilities given. So we have the ratios, right? The information we need for the ratios. Okay, then we also need accumulated profit. Please, accumulated profit is the same as retained earnings. You'll find it in the balance sheet at the equity side. So the retained earnings. So now we have all the information that we will need. Please, do you remember the formula? the first ratio, which is A, is working capital divided by total assets. The second ratio needed is retained earnings divided by total assets. We also need C, which is operating profit divided by total assets. Then we need D, our book value of equity divided by book value of total liability. Then we also need E, which is sales. I didn't pick the sales, but sales you get from the profit and loss divided by the total assets figure. Okay. So here, when you have your this, we have computed the ratios for the sales. Sorry, the various ratios. Please, the model would always be given to you as an attachment. But if you can memorize it, then it will be beneficial to you as well. So for the Altman Z-score, the first weight is what? 0.717 multiplied by A. Then we add 0.847 multiplied by B plus 3.107 multiplied by C plus 0.020 multiplied by D plus, please, are you with me?
Yes.
998 multiplied by E. So when we put it in, we have 125 as FANMOX 2020 Altman Z-score. So what would you say based on this?
It's not really performing.
This is a Z-score. So based on the cutoff point, we said if the Z-score is 1.8 or below, then the entity is likely to what? Fail.
To fail.
Yes. So based on this,
Not really fair.
we will conclude that FANMOX Ghana is likely to fail.
Yeah.
So you would do the same thing for various businesses that would be assigned to you. So please, class rep, do well and then submit the list.
Please, we can't hear you.
So I'm saying that what I have done on the Excel sheet with the Altman Z-score, you would be expected to do the same thing for your assignment, one of your assignments for this course. Where companies would be assigned to each class member.
I think your voice keep going and coming.
Okay, what I'm saying is that each member would be assigned a company that is listed either on the Ghana Stock Exchange or in Africa. You'd get their financial statements when you visit African Financials, Ransford. Your hand is up.
Do you have any idea of when you're going to close? Or you want us to finish this slide?
Any idea of
The time when you want us to close?
please do what? The assignment.
Close.
It means the time that will be closing.
Please, when I finish talking about the assignment and then you don't have
Hello?
questions, we are done.
Okay, that's fine. All right. Yeah.
But
All right.
the
Bye.
class is supposed to close at 5 or
Yes.
We did not go on
Yes,
break.
I know.
no.
Yeah. We've
And then
skipped
tomorrow
break,
too,
so
we
that's why
wouldn't.
I'm
I don't know
asking.
if Dr. Meku would meet you, but this is what I have to cover with you, and I'm done. So we are closing.
Oh, okay.
So what I was saying is that we would assign companies to. Ransford, your line is breaking. Please, what did you say? What did he say? Okay.
People very close. Just allow her to pray.
So okay, we would assign companies to you, but I want to understand that you get the Altman Z-score, what we have done, because it will be part of your assignment. You didn't seem to be asking me questions or this one like you were asking for the common size and the index. So I don't know if you understand or I can take it that you
Madam.
Yes, please.
If for the last, do go over the Altman Z-score again, okay? Maybe we're a little distracted. That's why I couldn't ask the question.
Using another year.
Someone is saying we should use another year.
It's the same
Okay.
thing. You can use another year, yes.
Okay, that's fine. So we use 2020. Let's use the, let me see if. Let's use the 2019 figures. I hope what I have done. Okay. Okay, what I have done picked, so we can go on. So this is 2020, 2019. I can't project the formula for you to see. So what I was saying is that the formula is usually given to you for the assignment that you do. The formula would be given, and then your slides. So the slides given to you already. It's there, and then you'll be using the Altman 2000 model to predict the failure of various companies that would be assigned to each of you. So each one will be different. The question might require that you do, maybe you do the common size analysis as well.
Please, we can't hear you all.
So for the Altman Z-score, we need to compute 5 basic ratios. The first ratio is working capital to total assets. Okay, so Let me hide this one, then, okay. So the first ratio, that is the A, is to compute the working capital to total assets ratio. Then the next one, which is B, is to check for retained earnings to total assets. That is also the ratio we computed. Then the C, the third ratio, is to find the operating profit to total assets ratio. Then D, you'd find book value of equity to book value of liability. Then E would be to pick the sales revenue or sales or revenue figure to equal to sales as a sales figure. Then you divide it by total assets. So when you have these ratios computed, you put it in the formula. And that was what I was saying, that with the weights, if you can memorize them, fine, but I believe it should be provided for you if you are required to perform this task. So the weight assigned to A is 0.717. Then you multiply it by the ratio you have computed for. Then you add it to the second ratio multiplied by its weight, which is 0.847. Then the third ratio is C. Its weight is 3.107. Plus the fourth ratio, and then its weight is 0.420. Then the last ratio, its weight is 0.998. So here in 2019, you'd have a value of what? 3.08. If you want to run it off, you will get 3.1. But when we computed the 2020 value, we had 1.3. So based on 2020 value, you would say that Farm Ghana is likely to fail. But if we are looking at the 2019 value, because it is 3.1, which is above 3, we will say that then the business is not likely to fail. So when you compute the ratio based on the score that you get, you would say it is likely to fail or not. If you have 1.8 or below, it is likely to fail. If you have 3 and above, then the business will not fail. In between 1.8 and 3, for instance, if you had 2, we can't know whether it is failing or not. So we call that gray area. So that is Altman's Z-score. And that is what you would be required to do. Please, do you get it?
Yeah, we get it.
Okay. So please, class rep, do provide Dr. Mriku with your class list so that assignments can be given, and then you would work on it. Please, do you have any question?
No.
So that we can close for those of us who want to run away faster.
Please, are we meeting tomorrow?
With me, no, because this is what I had to cover. But I don't know if Dr. Meku would make other arrangements for you. He would communicate it. We've come to the end of your section with me. So since you don't have any questions, thank you for your time. And then
We'll
for your
go a little,
contribution.
maybe we'll get a question for you.
Okay, I'm here.
You were, please, madam.
Yes, yes.
You were talking of the ultimate Z-score. You
Yes.
made mention of you used it like the current formula.
2000 model.
That means it's not the formula we are going to use, but there's a software and we are going to use the
No,
computer to
it's
do
a
that.
formula. It's not a
Like this,
software.
this
Let me
formula.
just, please, I'm coming. Let me just share the screen again. Please, this is the formula you'd be using. This is the one I used. So we computed working capital, which is current assets minus total current assets minus total current liabilities divided by the total assets. Then accumulated retained profit, which is usually the same as retained earnings or income surplus, divided by total assets. That one too was computed. Operating profit, I said in some instances, you may see it as profit before interest and tax. That would be your operating profit.
Do you know why I asked you this question?
No, please.
As that we are not getting the video now. So for us to also get it, I wanted you to go slowly to give me, if you are not getting this, you can also refer to the other alternatives. That was what I wanted to ask.
So okay, if you're not getting the video and then you have to do the
we may not get it.
assignment, if you have the slides, the corporate failure slide.
Yeah.
On slide number 57, the formula is there.
I've seen that. But the alternatives, like maybe is it operating profits? If you don't
okay. If that those
the
details,
alternative one, I wanted to jot them down so that I can
okay,
those details. Thank you.
So
Did you get me?
Yes, I get you. If we are computing for working capital. Working capital is the total current assets minus total current liabilities. Accumulated retained profits. You would find it in the balance sheet or statement of financial position. And then you would most likely see it as retained earnings or retained profit or income surplus. But most businesses, the current term to use is retained earnings. So most financial statements would show retained earnings. Then for operating profit, alternatively, you would see profit before interest and tax, or PBIT. PBIT. That would also be the operating profits that you would use. The book value of ordinary and preference shares is the total value for your equity. So when you go to the balance sheet, you would see equity, stated capital plus the retained earnings. That's the total would be your book value of ordinary shares and preference shares. Then the
Total
book,
capital equity.
please, what did you say?
Said the book value will be total capital,
Yeah,
total
the
equity.
value of ordinary and preference shares is a value of total equity, which is stated capital plus retained earnings. In some situations, you can have revaluation surplus or capital surplus there. So that's you pick
But that
the
is
equity. So let
Madam,
me
let's close.
when you pick the financial statement, okay,
Yes.
you would see equity and liability. The
Yes.
equity and liability, you will see equity first, then they will list some items before they total it. So the last total you see at the equity and liability before the liabilities come.
Okay.
It's the figure you pick as your value for ordinary shares and preferred shares.
Okay.
Okay. Then the total liability is your long-term liabilities plus your current liabilities. And then sales revenue is sales revenue. And Michael.
Madam, can we use Excel as you just demonstrated to do the calculation, the assignment?
Yes, but you would write a report. So when in writing your report, you need to show us your calculations. So if you can show us the calculations, the values that you have got, how you got to that point with Excel nicely, we would accept it.
Okay, so I was thinking probably in submission of the assignment, maybe we submit the Excel calculation as well as maybe the report in Word or something. I don't know if that's how it's going to be.
That is fine. Or you can also attach you can sometimes copy it to Word, and then if you do the formatting well, copy it to Word as your workings.
Okay.
Madam, my last question.
Yes, please.
Does it mean when we are talking of financial analysis, this is how we do it, right?
This is one of the ways you can do it.
Okay.
But when it comes to account and financial statements, okay, then you use ratios, and then you use the common size and then trend analysis.
So that means with this, we don't use the Power BI, Excel, whatever.
Since you don't
unless we are dealing with the model aspects.
You don't use, I didn't get.
Like for instance, with analysis, finance and accounting, this is how we use it, purposely using Excel. I'm asking, where does the Power BI and the R and the Python and the other ones comes in?
Oh, okay. So what you're asking me is beyond my knowledge. So
okay.
When it comes to financial statement accounting, okay, typically this is how you would analyze it. So these softwares, if someone is able to operate it and do the analysis better and then quicker, then it's good for the entity. So some of the things you are learning with regards to the other aspects of your course, you would need to be able to put it together to integrate it well so that you can be more beneficial to your company with this knowledge.
Yeah.
So
this
I don't know how those
manually,
softwares work. Please, what did you say?
This is the understanding it manually. You can use it to do, but understanding it manually will help you to interpret it using the software. Understand now?
Yeah. Okay.
Thank you. Thank you very much.
You're welcome.
Thank you.
Michael, please, your hand is still up. Or that was a previous one. Okay. So thank you very much for your time and then your contribution. We will meet somewhere, somehow, someday. I'll try
Thank you too.
Okay, I'll try as much as possible to get the recording to Dr. Mreku as soon as possible so that you would get it.
Thank you. Bye-bye.
Bye.